The U.S. stock market is currently closed, and as of the final closing bell on Friday, May 15, 2026 at 4 p.m. Eastern Time, Micron Technology Inc. closed at an exact price of $724.66 per share, marking a significant single-day drop of $51.35, or a negative 6.62% movement during normal trading hours, before trickling down slightly further in extended after-hours trading. While the headline numbers show a sharp pullback that has shaken short-term retail traders, the reality under the surface reveals an entirely different dynamic. For months, the dominant market narrative surrounding this memory chip maker was that it was merely riding the coattails of larger semiconductor design firms, acting as a secondary supplier caught up in a broader high-tech surge. The common belief was that memory remains a highly volatile commodity, prone to brutal boom-and-bust supply gluts that would inevitably drag the equity back to earth. However, this expectation completely misses a structural shift in how cloud providers are building their hardware systems. This business is no longer just selling bulk storage chips, it is integrated directly into the foundational architectures of advanced enterprise accelerators. When major investment houses recently near doubled their price targets, it was not because of a simple quarterly earnings beat, but because the actual addressable market for high-bandwidth data center systems is expanding at an unmodeled pace, establishing a long-term supply lock that standard cyclical models fail to compute. To truly understand what is happening with this asset right now, look no further than the dramatic trading volume and institutional shuffling that characterized the latest sessions. The recent 6.62% decline was not an isolated event. It occurred alongside a widespread tech sell-off triggered by spiking global bond yields and macro shifts that caused investors to pull capital away from high-beta tech equities. Concurrently, overseas markets experienced intense friction, with major memory competitors in South Korea sliding sharply as internal labor disputes threatened to temporarily halt production at major fabrication plants. Because three major global entities effectively manage the global high-bandwidth memory space, any operational friction or forced scale-down from competitors normally signals an open runway for domestic market share. Yet, because international tech indices pulled back as a single block, domestic shares were dragged lower in tandem, hitting a technical overbought inflection point. Only days before this slip, the relative strength index for the stock touched an extreme reading of 85, a glaring signal that a technical cooling period was overdue. Institutional desks used this macroeconomic air pocket to capture profits, liquidating large chunks of stock that had run up heavily over the previous weeks, which explains why daily trading volume spiked well above the historical average as blocks changed hands. This recent price action highlights the constant friction between what casual investors see on basic investing sites and what institutional desks look for on advanced trading platforms. When retail participants log into a standard online investment app or use a simplified robo-advisor, they often look at trailing metrics and assume a sudden drop is a sign of operational failure. In contrast, funds executing high-volume orders through an individual brokerage or an interactive broker's account view this volatility as a structural entry window. The broader tech sector is seeing a massive capital reshuffle, and while high-profile semiconductor designers command the headlines, the high-performance memory modules co-designed for next-generation GPU platforms are proving to be the literal gatekeepers of computational speed. This structural reality is why major bank analysts have aggressively upgraded their terminal projections, looking past current daily swings and modeling a multi-year landscape where demand structurally outpaces total global fabrication capacity. When assessing the broader landscape, it is vital to keep context on how memory technology interacts with the wider tech market. Think about how major index heavyweights like Nvidia stock, Apple stock, or Tesla stock command vast allocations in traditional mutual funds and institutional portfolios. For years, self-investing individuals using traditional platforms like Fidelity Investments or checking their balances via a Fidelity mobile app focused heavily on those consumer-facing and logic chip brands. But the architecture of advanced computing has changed. An elite logic chip is useless without high-bandwidth memory to feed it data at near-instantaneous speeds. This technical dependency has forced a massive reevaluation of memory producers within diversified portfolios. Large asset managers, whether managing specialized Fidelity ETFs, broad Fidelity mutual funds, or executing tactical trades inside a Schwab Intelligent Portfolios account, are recognizing that advanced hardware cannot ship without specialized storage layers. Consequently, a stock that used to be a note in a standard individual brokerage account is now a core holding that drives the performance of entire tech-focused funds. Comment below how many shares of Micron Technology you currently hold in your portfolio, and whether you are buying this dip or waiting for a deeper technical correction. If we look back at the company's structural history and core business model, its past performance serves as an excellent case study in how a legacy business repositions itself. Historically, the firm operated as a traditional cyclical semiconductor manufacturer, producing standard dynamic random access memory and flash storage for personal computers, mobile phones, and consumer electronics. In those decades, the financial health of the business was completely tied to global consumer demand cycles. When consumer hardware sales stalled, memory supply would pile up in warehouses, prices would plummet, and the company would face severe margin compression, a pattern well documented across early investing sites and old financial reports. But over the last last several years, management systematically pivoted their engineering focus towards specialized high-margin enterprise products. By developing proprietary vertical stacking techniques where memory dies are layered on top of each other and connected via high-speed microscopic vias, they broke away from the low-margin commodity trap. This technological turn allowed them to secure long-term binding supply agreements with enterprise cloud platforms, effectively insulating a massive portion of their revenue from the erratic swings of the retail consumer market. This fundamental transformation is vividly reflected in the jaw-dropping financial metrics reported earlier in the fiscal year. During the fiscal second quarter, the company posted total revenues of $23.8 billion, a staggering 196% increase compared to the same period in the prior year, alongside a massive surge in net income that blew past every consensus estimate on Wall Street. Even more telling is management's guidance for the upcoming fiscal third quarter, where they projected revenues to scale up to $33.5 billion, representing an accelerated year-over-year growth rate of 260%. In a traditional commodity business, such numbers would be impossible to sustain. But because advanced memory wafers require significantly more complex manufacturing steps and cleanroom capacity per gigabit than legacy chips, the global supply of memory is being kept artificially tight. This supply constraint gives the company immense pricing power, allowing it to lock in premium contract pricing that directly expands its gross margins. Looking ahead, the forward-looking thesis for this asset relies entirely on the interplay between supply constraints and future infrastructure deployment. The company has already publicly confirmed that its entire production capacity for high-bandwidth memory is entirely sold out for the remainder of this calendar year, with binding customer commitments stretching deep into the following year. This means that near-term revenue is essentially capped only by how fast the company can construct new cleanrooms and secure specialized packaging equipment. For investors managing their own capital through self-investing or utilizing automated tools like a SoFi robo-advisor, the core question is whether the market has already priced in this hypergrowth phase. At its current valuation, the stock trades at a surprisingly low single-digit forward price-to-earnings multiple relative to projected outer-year earnings, a massive disconnect from the premium multiples commanded by the broader semiconductor industry. This valuation gap exists because the market narrative is still treating the company like a cyclical steel mill, expecting a sudden crash in pricing, while the operational reality points toward a prolonged structural deficit in global memory supply. However, executing an investment strategy in this space requires a sober analysis of the distinct operational risks that could derail this growth trajectory. The most pressing threat is the hyper-competitive nature of the global memory triad. If competitor fabrication facilities overseas recover faster than anticipated from their domestic disruptions and aggressively ramp up their next-generation chip production, the current premium pricing environment could soften sooner than the market models. Additionally, manufacturing these hyperdense memory stacks introduce immense yield risks. A single microscopic defect in a multi-layered silicon stack can ruin an entire wafer, causing sudden drops in production efficiency that could squeeze projected margins. For retail traders using nimble platforms like the Robinhood app to chase memento, or long-term investors managing assets across Fidelity IRAs and premium interactive brokers accounts, tracking these technical yields and competitive capacity additions is far more critical than watching daily chart noise. When we synthesize the entire picture, the contrast between market expectation and operational reality becomes crystal clear. The crowd looks at a sharp single-day decline of over 6% and panics, viewing it through an outdated lens of commodity cycles and short-chart macro anxiety. The deeper analysis reveals an enterprise platform partner whose specialized products are deeply integrated into the world's most critical computing infrastructure, backed by explosive tri-digit revenue growth and forward order books that are locked in for years. Volatility will remain an inherent feature of this stock, driven by broader tech sector liquidations, shifting interest rates, and technical cooling cycles. Yet for those analyzing the market with professional depth, the underlying tension between a lagging cyclical valuation and an accelerating secular growth profile creates one of the most compelling setups in the modern technology landscape. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.